Welcome to the February edition of the Aftermath. We'll dig into talking markets and quite a bit more here this morning. February, pretty key month for a lot of us in the insurance business. What the markets do this month matters a lot for the base prices for crop insurance. We're currently getting those set. In the South, we're just about done. In the North, we're about halfway done. Pretty important time from a risk management perspective as well, historically. We'll look at some of that here as we dig in. Buckle up. We'll take you through what's going on in the markets. To me, these are the biggest factors that we're looking at right now. USDA at the top of the list. They've given us, I would say, a couple of surprise reports. Back in January was definitely a shock to everybody's system when the government came in and lowered the corn, lowered the soybean yield. Big cuts. Had the tied for the record biggest cut we've seen from November to January in corn. A full bushel lower in soybeans is about a 2% cut there as well. So those were big, and those have really been the basis for what's happened in the market over the last month. Now, yesterday didn't make any significant changes. We'll look at that here. In the U.S. numbers anyway, at the world level, you did see some drops in stocks. The majority of the bean stock drop came from a cut in the Argentine bean crop, 3 million tons. And corn and wheat, we'll look at a few of the numbers, but probably the most significant change we saw was USDA reduce the Chinese import number, reduce their crop number as well, but reduce the import number significantly in both corn and wheat. And that was kind of a shock to the report, maybe a little bit of a hit to the bulls. That China is not going to be buying grain. And I think USDA kind of pointing that out. Exports, trade, tariffs, put all these in together. Certainly a big deal right now. And when you look at tariffs, it does matter for these markets. And Susan Stroud shared this chart here recently showing exports and imports from Mexico, Canada, and China. And I added down here the crops or the commodities that we really rely upon. Mexico, we're a big supplier of corn to Mexico. That's going to matter a lot. What happens with ethanol going into Canada matters a lot. Conversely, what happens to wheat coming back across the border from Canada? So we've got some different things going both ways. Soybeans, cotton going into China certainly matters. And so as some of the trade talk takes place, this is going to matter. What's going on with the EU? Well, we announced this week 25% tariffs on steel and aluminum coming into the United States. And immediately the EU said, well, we're going to have to take action against that. Well, you could argue that the EU has been tariffing the heck out of us for quite a while. And if you look at some of the key ag exports into the EU, beef, pork, poultry, you can see the list here. They've tariffed the heck out of the United States. So to say they're going to have to counter would kind of say, they've already done that. So we'll see what ends up happening there. The managed funds, we'll talk about their net positions, update you on where they're at on all these crops. And then South America, what's going on down there? Brazil getting into harvest, well into harvest now. Weather-wise, it looks a lot better here over the next 15 days. They should be able to really crank things up in Argentina. We did mention earlier that they had cut the crop size, but it looks like they're going to get they've gotten some pretty good rains over the last week and maybe going to get some more here that's going to hold that crop steady. So we'll dig right into the corn market. This is from last month, but these were the final state yields from the January crop report. The red numbers were the ones that were lower. The green numbers were up from back in November. Overall, again, USDA lowered the yield 3.8 bushel an acre down to 179.3. That is a record. But we still have never grown a 180 national yield. Even though we start out projecting that every year, 182, 183, it's still never happened. The states with a pound sign did have records this year. So South Dakota, Iowa, Illinois, Michigan, New York, Arkansas, Louisiana all had record state yields. And if you look at the updated balance sheet from yesterday, USDA did not change a number. They stayed with the production. Of course, that production is locked in. On the demand side, feed, ethanol, still pretty strong numbers. Exports, they kept unchanged, even though we're probably on a pace to be above 2.45 billion bushels. So it'll be interesting to see if eventually USDA raises that number or if they think exports are going to slow down and are truly front loaded this year. And I guess that's the biggest question. But this 2.45 billion is back where we were 3 years ago, and that's when China was buying U.S. corn, and China's not buying any corn now. So ending stocks stayed at 1.54 billion. I read one trader this morning. He thought in his mind that USDA could go to 1.3 or somewhere that direction based on the current pace of exports. So again, what is USDA thinking? Do they think export sales are going to slow way down? We're not going to get much competition out of South America until probably July, if at all, depending on what their crop looks like. So that's the question. Is Mexico bought up? Is Japan bought up? Did they buy early? Are they going to continue that pace? That's what the market's trying to answer right now. Average farm price went up a dime to 435 in yesterday's report. And the reason that the only place that this is important is for the PLC and the ARC County programs at the FSA office. So at the end of the marketing year, they will use this price, and the end of the marketing year is August 31. So we still got a ways to go, but for the purposes of those programs, that's why we're looking at these numbers. So exports been a phenomenal run this year. Some people talking about exports being up over 2.5 billion based on the pace that we're at right now. We'll see if we can get there. If we do, we're matching one of the best years we've ever had. Biggest reason one of the bigger reasons, price has certainly been a reason why we saw big demand early in this crop year. But also you look at our competition, Argentina, Brazil, Ukraine, don't have a lot of corn right now. So if people need corn, they're having to come to the United States. And one of the big factors in all of this has been Brazil's domestic usage. Brazil is cranking up ethanol production, kind of like we did back in 2006, 7, 8. And so as they use more corn domestically, that leaves less for export business. And so we're benefiting from their policies domestically, and that's a great thing for the U.S. corn market. And if you take the United States out and just look at the other three countries by themselves, they're at a 42-year low in a stocks to usage ratio right now. So you can see how things have lined up. It's kind of been a double whammy for the corn market. We saw USDA lower production. We saw demand improve this year quicker than we would have expected. And that ending stock number was once 2.2 billion. Now we're down around 1.5 billion. And so while we're not going to run out of corn, certainly it's painted a much more friendly picture to the corn market, and that's why we are where we are. Now, I did mention back at the beginning, USDA lowered the Chinese corn and wheat import numbers. You can see this chart kind of reflecting that. So maybe that's a bit of a disappointment for the bulls. But here's where the funds are at in corn. And, you go back to 21 and 22, the gold and the purple lines up at the top, when these funds were holding big time long positions in corn, pushed up to 400,000 contracts long. The reason back then was China. China had blown into the U.S. corn market for the first time since the 90s and started buying U.S. corn. And life was good, right? We had taken corn up into the 6s and 7s, and prices were hot, and the funds had given us that rally, and stocks were tight. We couldn't really screw up from a marketing perspective back there for 2 or 3 years. But when China disappeared from the U.S. corn market in 2023, these funds decided, they recognize that stocks are going to start to grow here in the United States without that added demand. And so the funds took their money, went elsewhere with it, liquidated, actually went short the corn market by the spring of 23. You can see the red line. They spent almost all of 23 and 24 short corn. And as of last July, they were holding a record short position in the corn market. Since July, it's been an incredible turnaround. We've never seen anything to this extent where the funds went from 350,000 contracts short to 360,000 contracts long. So that's over 3 billion bushels, 3.5 billion bushels of corn that they bought just over the last 7 months. So an incredible turnaround. And I give these people a little bit of credit for figuring out what was going on before USDA did, actually. They recognized that cheap prices back in late summer were starting to stimulate new demand, that we were seeing Mexico coming in and contracting new crop delivery grain. We were seeing other countries start to slide in. We were seeing ethanol production running at, near record pace, if not record pace. And so these funds decided, you know what, corn's too cheap to be short, bought back their short position. We had a rally in crude oil at the end of the year. We rallied oil up $13 a barrel, which, if you look back historically, and I don't have the chart, but there's been a strong correlation between oil and corn over the last 10 years, especially in the weekly and monthly charts. So that rally in oil, I think, helped put corn with it. Then you had the January crop report, which caused these people to buy even more. And so now you've got these funds long 360,000 contracts of corn. Uh, this is the fifth time that we've ever had a position this large: 2010, 2011, then 21, 22, and now here in 25, funds are holding this big a position. So to me, the question is, what are the funds going to do? If you can tell us that, you know what the corn market's going to do, I think. Uh, but, there's nothing that says they have to liquidate yet. And I still think there's a strong feeling that this corn stock number is probably a little bit tighter than what the government's currently showing. So I could see a situation, at least over the next 60, 90 days, where the funds probably want to hold this position, wait and see what happens with the South American production number, wait and see what happens with U.S. acres this spring. Uh, if things turn out well, if the South American crop is good and we increase acres to, 95 million, then I could see a situation here seasonally. You get out into this May, June window where you could anticipate the funds probably lightening up their position, kind of like they did in 21 and 22. So I think that makes a lot of sense given the current status of supply demand of corn. And so looking at March futures, it's been a whale of a run. You go back to August, March corn made its low. Back then, we had September corn traded down to 363, I think. So we had a huge carry in the market. The market was inundated with corn. Nobody wanted corn. Basis levels were extremely wide. People were putting corn on the ground before harvest. It was nuts. Then things kind of slowed down. You got into harvest and we had space. All of a sudden, everybody was empty and we filled up. Markets rallied. You saw a little bit of selling middle of the harvest. And then even as late as Thanksgiving, we were trading 4.25 corn. And then I think this part of the rally was driven by the rally in crude oil. Then you had the January crop report. And since then, we've been able to put at least another 30 cents on this corn market. We've kind of stalled out around the $5 level in March corn. We've taken the 5-day moving average and turned it lower. The 20-day kind of flattened out a little bit. Here this morning, I had to update the chart again after the day session started because we were back up a nickel. And so I didn't want to show the night session being lower. So things have kind of moderated a little bit. We were stuck right at the 9-day moving average here this morning. Where do we go from here? I think it's going to be the funds that drive this thing, and where do they want to go? We've got to wait another month until you get the next USDA report. But we do get weekly export sales numbers every Thursday. I think those are going to be really important. We'll get another one tomorrow, and it'll tell us what we sell last week. And if we're continuing to run at a 1.5 million metric tons a week, USDA will almost have to change their number at some point. If sales start to slip back a little bit, then maybe we start to think that, well, maybe this demand was very front loaded and we're not going to see as much later in the year. So that's going to tell the story, I think. Next week, I believe we will get our updated baseline projections from USDA regarding acres and supply demand for the coming year. Then March 31, we'll get our planning intentions report. It'll be kind of interesting to see what they tell us then, because trying to do some what ifs here. Oh, by the way, go back to March corn. If you've got old crop corn in the bin, we're a little bit off the highs. If you look at the RSI and the stochastics, I had taken this contract out of the hot zone the last few days. That said, I still think minimum price is a good way to be marketing right now. If you want to sell, buy an out of the money option in case the market continues higher. Right now, though, the market is telling you to hold corn. We've gotten slammed with corn over the last 30 or 45 days. The market has. The spread between March and May futures is out to 14 cents right now. That is historically wide. That's a huge carry. Tells you the market is, the pipeline is full at the moment. They do not need any more corn. So if you're looking to market, your best bet's going to be going out to April, May, June, somewhere out in that window. You're going to be able to take advantage of the carry. But you'll get much better basis. Plus, you get that 14-cent board carry as well. So that's what the market's telling us right now. But if you want to sell corn at 490 and go buy an out of the money call, or sell May corn at what that'd be 503 this morning, go buy an out of the money call in case the market goes higher. I think that's a great deal, much better deal than we thought we were going to get just 2 months ago. So looking ahead to 2025, I've got three different scenarios on here. Number one, Informa Commodities came out a couple of weeks back at 93.5 million acres this year. Scenario number two is if we revert back to last year and plant 94.6 million acres. I think that's easily doable this year, assuming people have got their fertilizer locked in. I'm hearing some rumblings maybe that nitrogen prices might start inching up here a little bit, and maybe that's partly because of talk of more acres. So I think if you're talking more acres and you're going to plant more acres, probably need to be locking some stuff in, both on the input side and even on the sales side. The third alternative is 97.2 million acres. That was the record we planted back in 2012. I don't think we're likely to do that, but I did read one analyst the other day say 98 million acres potentially this year. So, I always say the first liar doesn't stand a chance. And so we'll see what eventually happens. Now, I plugged in a decent yield, probably slightly under trend, and the bigger the acres, a little lower yield. So regardless, we're looking at having over 17 billion bushels in supply under all three scenarios. I do think demand should stay firm next year. I think the feed numbers are going to be locked in pretty well. I don't think we're going to change a whole lot there. Ethanol, barring any kind of a policy change, ethanol grind should continue to run at capacity, 5.5 billion bushels plus. Export demand looks to me like it's going to stay firm. Unless something dramatic changes, I don't see any of the other three big exporting countries having a lot of extra corn to ship next year. So as long as the demand's there now, I would tend to think the demand sticks around. Higher prices may limit that a little bit, but I'm using some pretty aggressive numbers here. And even with that good aggressive demand, we're still looking at potentially 2 billion bushel carryover. So that being the case, I could make a case where the funds decide to stay long corn on into spring. If we get 94, 95 million acres planted, I would anticipate they'll be trying to liquidate some of that. And so as you look at December 25 corn futures, we're on pace this morning with the market higher to have our highest close since back in June. I do still have this one in the hot zone. We've got the RSI at 66, stochastics bumping 90 right now. I think this is a great opportunity to be marketing some corn. And I've been saying this since, back when we were 430, I said if we get to 450 to 460, get back to these fall highs, I wanted to get started. And then probably 10% increments every dime or so. And so here we are, 473. I think it's a good opportunity. If there's a chance we're going to plant 95 plus million acres of corn this year, the odds of staying at 473 are probably not very good. So, assuming we have a decent crop. So I think it's a great place to get started. And if you look at the history of corn prices, this window really from now till about the beginning of June is the best time to market corn. And I know most of us aren't going to sell the entire crop or even half the crop at one time. You may say, I'm going to wait till June 10th and sell 50%. I guarantee most of you won't. So I think you want to sell into the rallies. And I count rallies by the times, if you look at the indicators, the relative strength index, stochastics, how many times have we pushed the RSI to 65 or greater, stochastics up into the 70s, 80s. Really, this is the third time in the last 8 months we've done that. So sell the rallies when we get an opportunity, lock something in. I don't know what we're looking at overall for this year. I think it's going to be a challenging year, trying to cover expenses. That's why we want to make sales when the market gives us opportunities. Also, if you missed it, you want to go back and look at our market report letter from Friday and again on Monday. I did talk about some ways to market new crop corn without just selling it. And so some different alternatives that continue to keep upside open for you. Minimum price contracts, buying puts, buy a put, sell a call, take a floor and a ceiling. a three-way option trade, which is a floor and a ceiling, but also limited downside. I talked about that a little bit. I think that's not a bad way to get a floor up pretty close to where the market's at. And then, of course, revenue protection using the ECO, especially program this year. We'll talk about that here in a little bit. Soybeans, similar to corn, we saw USDA make some cuts in this last report. All the red and the pink states were lower. The only two states that had records this year were Arkansas and Mississippi. And if you look at the U.S. balance sheet from yesterday, they made no changes. Actually, well, they made one change in the U.S., and that was the average farm price down a dime to $10.10. 380 million bushel carry out. We're not going to run out of beans this year. We're going to have plenty of beans. That's the the highest in 4 years. So, we're not getting tighter like we might be with corn. And in fact, some people think that based on the exports should be lower, that ending stocks might be a little higher than this eventually. So the export numbers, the number that kind of is discouraging. We've known that for a while, that China is going to continue to buy more and more of its beans out of Brazil. The positive is domestic crush. 2410 continues to be records. We continue to set a record every month. So that's the good side of things. If you look at the world balance sheet from yesterday, USDA lowered Argentine production 3 million tons down to 49, still kept Brazil at 169. Most analysts have that crop over 170 right now. So I would anticipate that crop getting a little bigger. Domestic crush running at a record high around the globe. Exports still strong. Ending stocks, even though they dropped a little bit, still a record this year, 124 million tons. So we're at the world level, which I think takes more importance now than U.S. balance sheet numbers. We're still looking at a huge number. Now, here domestically, I mentioned that the crush is at a record high. Here in December was a record high number. January is probably going to set a new record for the month of January. So we're going to continue to do that as long as we've got new plants coming on board. And we've got several coming on board here this year. On the export side of things, we are up from last year, but we're below the 5-year average. And we don't appear to be seeing much gain in ground because the big reason is China. A, China prefers to buy Brazilian beans when they can. But B, if you look at the supply of beans in China right now, they're sitting on a lot of stocks. And so they really just don't need to buy a lot of beans, period. And so with the lot contracted coming out of the field in Brazil, the U.S. sales just don't look like they're going to be that tremendous here for the next several months. I mentioned the crops a minute ago, but if you look at the big three production, we're third straight year of a record high, even with the lower Argentine crop this month. I anticipate this Brazilian crop number is going to get a little bigger when it's all said and done. So we continue to raise the heck out of beans. And if you look at the latest weather, just pulled this off this morning, the 15-day anomaly, it's going to be drier in Brazil, which is really going to get the harvest cranked up. They got a lot of vessels waiting to get loaded, running about a week behind getting started in Mato Grosso. Which means they're a week behind getting second crop corn planted. And so it looks like the weather is going to fare pretty well over the next 2 weeks. They ought to get a lot of harvest done. Down south into southern Brazil, Uruguay, eastern Argentina looks to be a little wetter. And it's been fairly good over the last week or so. So I think we've at least stopped the bleeding on the crop down there. So overall, forecast looks pretty good. And in the big picture, when you look at stocks, I mentioned this a minute ago, we're looking at a record bean stock level number at the world level. So just kind of hard to get too excited, too bullish beans, given that we're going to have a lot of supply. So when you look at price right now, and this is the other side of it, why it'd be hard to be bullish U.S. beans. If you look at U.S. bean price in pink compared to the Brazilian price in green, our beans are running $1.10 higher than theirs for the month of February. Even a little greater spread for March, April. That spread may tighten a little bit as you get later in the summer, but I think you're going to go all the way out into August, September, even October, where you're going to see Brazilian beans cheaper than U.S. beans. Because if they're harvesting 170 million tons of beans and they got off to a late start, they're going to have a lot of beans to ship here over the next several months. So expect to see competition this fall when we're into harvest. Expect to see wider basis levels this fall. If you're not seeing that yet, you might want to consider locking that in, especially if you're tributary to the export market. So here's where the funds are at right now. Funds that kind of like corn spent, the better part of 2 or 3 years heavily long beans. Last year at about this time, they went to the short side of the soybean market, stayed short for several months. You got into early fall, they bought back a chunk of their short position, and that was on the heels of some pretty good bean oil demand, taking the place of a short palm oil crop this year. And so that gave the funds the first chance to buy back. We had harvest. Then the funds bought back another chunk of their short position, especially following the USDA report in January. And as of last Friday, they're long about 60,000 contracts of soybeans. Uh, so again, what will the funds do? If I'm a hedge fund trader, I don't want to be long beans right now. If I'm a farmer, I don't want to be long beans, especially in the United States, because you know that Brazilian beans are a lot cheaper. We've got so much competition. I just don't see a reason why this bean market has to get too excited. The only thing I can think about right at the moment would be lower acres. If corn acres and tended acres jump dramatically and bean acres drop back a little bit, maybe that kind of flattens things out. But it's been a whale of a rally in March beans. When we were sitting down here at 9.5 bucks, uh, a lot of people were talking about going to an 8 in front of it by harvest. The drought in Argentina kind of stopped the downside trade and brought the funds back into the market here. Plus, you had the USDA crop report on January 12th that added some more buying. And so taking us up to, close to a 1080 high. Now we're trading what, 40 cents, 45 cents off the high here this morning. I still think I'd want to be liquidating my old crop beans. And I've said this for several months that I want to be out of beans by the end of January just because of the price comparison with Brazil. I still feel that way. If you decide you want to stay in the market, go buy an out of the money option. But we're certain, we're still almost a buck higher than the low. And I think, even with the indicators moving kind of into oversold right now, I still think it's not a bad place to get out of the bean market. So that's my thought on that. Looking ahead to new crop, I put three scenarios out here. What if we planted 85 million acres, which is USDA's baseline estimate back in November? What if we flip corn and beans back to where we were just in 2023? I think that's doable this year. And then the third would be is if we did plant a record corn crop, then bean acres would probably slide back to 81 million. I used a trend type yield at 52 bushels, used very strong crush demand, consider that export demand's probably going to be under pressure in the year ahead, and you go anywhere from a 50 million bushel increase to the same to potentially a decrease in ending stocks depending on acres. So again, the U.S. numbers don't look too exciting. It really all boils down to South America and really Brazil. So how many acres do they plant next fall? What's their crop look like next winter? Those are going to be some of the deciding factors here as we move forward. So November beans, to me, they've given us one heck of a rally to take advantage of, even though we're off the highs now. You can see we did have beans in the hot zone here for about 2 to 3 weeks when we made our high up at 1075 and 3/4. We did break the downtrend line. We did push through the 200-day moving average only briefly. And now here we are this morning back below the 9 and even the 20-day moving average. So not looking real sharp right at the moment. I still think it's a good place to have some locked in. And if you look at the historicals and means, here we are, the middle of February, from now till May, that's usually our better window. Maybe get a spike in June, but, this is our best window to market beans. And so I think that matters this year too. I think that makes a lot of sense. So I'd want to be chipping into this thing and, every 25 cents, put some offers in. And if we rally, sell another piece of your expected production. On the wheat, USDA also did not make any significant changes to the balance sheet, did make just a slight tweak to food usage, slight drop in ending stocks, kept price unchanged. Looking ahead to this coming year, they're really looking for the balance sheet to be almost the same. It's kind of scary close, ending stocks just a fraction higher next year. The world continues to matter more in wheat for the most part than U.S. Numbers. And the big story this year has been the Russian crop being down. Drought really impacted their crop, expecting to see exports drop. This was a few weeks ago. Soybean was expecting exports to drop to 45.9 million tons. I think I've seen that number come down to maybe 43 million tons by another analyst. So they're going to ship less wheat, which had given the bulls some ideas that, okay, maybe we're going to get some demand to come to the United States. And And we've seen some decent export numbers. Export shipments have been decent. And if you look at the world supply demand numbers, from yesterday, USDA bumped Chinese production slightly, made some cuts to trade. I think that was probably what's interesting. Exports and imports went down. Ending stocks did drop about 1 million tons in that report. And if you look at the biggest exporters here on the right, you can see which countries are included in this. World stocks and stocks to usage are going to be at the lowest level, since 2007. And so it's not bearish right now, but I hesitate to call it bullish because we've still got enough wheat. We're not going to run out of wheat. And the U.S. is the country that's probably holding the biggest supply or the biggest reserve, because all of these other countries on the other side of the globe, except for Canada, they're all generally closer to where the demand is. Egypt is a big importer of wheat. And so, they would prefer to buy stuff that's closer to them. So this did give the U.S. market a little bit of hope here this year. And if you look at the world versus U.S. numbers, world stocks continue to tighten. U.S. stocks grew this year. And a lot of that growth was in soft red winter wheat, which it tends to be the last wheat of resort to the world as far as demand goes. But you can see where the funds have been in Chicago wheat. Uh, they did get long back, a couple, 3 years ago, but generally speaking, over time, funds tend to trade wheat from the short side. 23, 24, on into 25. They've been on the short side of the wheat market, pushed down not far from a record short here at the beginning of February, and now they bought back a little bit of that. But had a little buying run back late summer when they were starting to buy corn and bought soybeans. They bought wheat. And if you look at wheat right now, wheat's the cheapest thing in the market. And I certainly think that, if I were a feeder, I like the idea of, at least exploring using feed wheat. Chicago, soft red winter wheat compared to corn might work into some feed rations in a lot of places. So be kind of curious to see if that does happen. But it's been a whale of a move. For several months now, we've looked at the 100-day moving average as a target. And even though that's trended lower, but we did get back above it here this last couple of weeks, did trade back above $6, kind of stalled out at the 200-day moving average. I still think one of the things I mentioned last month, looking at the revenue protection price. And when I market, that's one of the things I always try to look at is, can I improve on my insurance guarantee? Your insurance guarantee used 5.94. If I could sell $6 plus wheat, I can improve on that. And so at least on the bushels I sell. So today, even with the market a little bit lower, 5.97 and a half, we're still right around that $6 level. I think it's not a bad place. And for the first time in a few months, I actually had wheat in the hot zone here the last couple of days. We'd had the RSI up pushing 70 and stochastics up into the 80s. So it's, I think, given us, again, an opportunity to take advantage of. Same in KC wheat, just slightly different picture, slightly different charts or prices. Well, again, we did take out the 100-day moving average, traded above the 200. Traded above the insurance price, still above it here this morning. So I still think it's not a bad place to be. If you need to make some sales or want to get started, pretty good place to be chipping something in. Minneapolis March wheat, it's kind of been the trailing market of the three, but it also had a nice rally, 60 cents. We've backed off the high a little bit. Again, indicators have kind of weakened a little bit, but still not a bad place to be pricing a little old crop wheat if you got some, and maybe replace it with an option if you don't want to just sell it outright. And then looking ahead to new crop, I think we're still in the same boat. I think it's a good opportunity, a good rally to take advantage of. We just don't get a lot of them. So, up here, $6.50. If you're going to plant spring wheat, I think it's a good place to chip in a little bit of a sale as well. And then finally, cotton. Look at the report from yesterday. Once again, USDA gave us a negative number, and that was domestic usage. They cut 100,000 bales off the domestic number down to 1.7 million bales, which raised ending stocks to 4.9 million bales. Took the average farm price down to 63.5 cents. That was down a cent and a half. So just can't get any traction in this cotton market. And this probably tells the story. World U.S. stocks to usage continue to rise, and that's the problem that the cotton market has. And the problem it has is watching what's going on in China. And if you look at their GDP, Each time they try to pass a stimulus package, it just seems to not really go anywhere. They had, what, 6 out of 7 months of negative GDP at the end of the year. So it's just a tough road to hoe right at the moment. And the funds have continued to just lay on this market, holding a record short position now in cotton futures. If you wanted to be an optimist, if you are an optimist, you would look at this and say, well, if something changes, they got a lot to buy if they want to get back to zero. So to me, that's the most optimistic thing I can point out right now. And it did happen. You look last year at about this time. Last year about this time, funds were short cotton. We saw a stimulus package passed in China, and that was enough to really get these funds excited. And they bought a bunch of cotton, and then it didn't do anything. GDP numbers didn't improve, sales didn't improve, and they went back to the short side again. So it can happen. I just want to probably wait for it. If you can do that, looking at markets right now, we're oversold. We've been oversold. We've improved a little bit the last 2 to 3 days. We have pushed up to this downtrend line and the 50-day moving average this morning. So let's see if we can at least take out, let's baby steps. We've got the 9, the 20-day starting to turn higher. Can you trade above the 50-day? If you do that, next target is this 100-day at 70.5 cents. That probably would indicate that the RSI and stochastics are probably getting toppy at that point. So that might be your level to be selling. And then you got the 200-day moving average at 72 cents. So I think those would be some reasonable targets if I've got old crop cotton left to sell. Looking ahead to new crop, acres are going to be interesting this year. USDA was projecting 10.8 million back in November. I'm not sure if we'll raise 10.8 million. I understand the reluctance of a lot of people to cut acres, especially people I've talked to in Texas don't plan to really reduce acres. I think in the Delta, I would not be shocked to see Mississippi, Louisiana, Arkansas cut a few acres out, maybe plant a few more acres of corn, soybeans. Maybe in the Southeast, you see something similar as well. Plant something else, even if it's peanuts or something different than cotton. So I think that could happen. Maybe you shave that number down closer to where we were 2 years ago. But using USDA's balance sheet numbers from back in November, they're projecting, we'd be well over 5 million bales next year. So we'll see what happens. But I do think that the market is trying to tell us not to plant 10.8 million acres. So I don't want to be selling in a down market. This market, really, it's kind of interesting. You look at the stochastics short term at 82, 83. I mean, this thing has quickly bounced. Now, not back to profitability and not to a level that I'd want to be a seller, but certainly a sustained rally over the next few days. If you break the downtrend, get back up to the purple or blue lines here, might give us an opportunity to lock in something for this coming year. So let's keep an eye on this market. So looking ahead to 2025, we've talked about the grain marketing piece of the puzzle. To me, this is what I view my job is to try to put grain marketing together with government programs and crop insurance to create a solid plan and complete the puzzle for the year ahead. And so as we look ahead for crop insurance, we're primarily looking at these 4 products here for the next month. At the FSA office, once again, we're choosing between the PLC and the ARC programs. And so just a quick reminder in case you forgot what these programs were, RP coverage is up, individual coverage on your farm up to 85%. SCO is county coverage that starts at 86 and goes down to the RP level. ECO covers that top end from 86 to 90 or 95. And I've got the blue light on ECO this year. That's the blue light special because ECO, the government copay this year, I'm not going to use the S word, the government copay went from 44 to 65%. On a crop like corn, that's going to cheapen the ECO up about $10 an acre. On beans, it's about $6 an acre at the 95% level. So I think that's going to be a game changer for a lot of people who are interested in trying to get enough dollars of coverage to cover their expenses and can't get it done with RP. ECO is going to hopefully allow them to get that done. Then we have the stacks insurance policy. On cotton, starts at 90%. It's county coverage down to your individual level. It's subsidized at 80%. Excuse me, government copay is at 80%. So stacks has always been a heck of a deal if it made sense in a given year. So At the FSA office, then you got two programs. You got PLC, which is price only. You could sign up for the PLC program, not going to have any impact on what you do on crop insurance. Ark County does. Ark County is a revenue-based program on the county. It starts at 86%. It's a 10% band, but you cannot do Ark County and SCO. So to me, the first thing I decide is which program makes the most sense for me. Or on cotton, does either program? Because you can't buy stacks if you buy one of the or sign up for one of these. So that to me is the first thing you have to do. Decide which program makes the most sense for me. That's going to eliminate some of your choices and help clarify what you can do on the crop insurance side. So let's take a look at this. To me, this is like your ladder. How many rungs do you want on your ladder? How tall do you want your ladder to be? How much space do you want at the top of your ladder or your deductible? And so your individual coverage, that's your level in blue. That's up to 85%. Depending on where you're at, 85 may or may not be a palatable option. That next band above that then is SCO or County Arc. Cannot do both. Or you could put stacks in here as well. So you'd have to make a decision which either or. Above that is ECO. And you can do ECO no matter whether you sign up for ARC or SCO. You could sign up for the county ARC at the FSA office, still buy ECO protection because it does not overlap with the county ARC. So I can still get that top band or that top rung on my ladder, leaving myself a little less space at the top or a lower deductible. So the way to come up with a decision on that, to me, is looking at the prices that we've got right now. I always go into a year assuming we're going to have an average crop. So when you look at the PLC program this year, those are going to be the prices in blue. Those are the reference price or the support price for the PLC program. 426 corn, 966 beans, wheat at 556. You can see sorghum going up as well. Some of these markets had an escalator this year because the Ark County price going up. They get to trail and stay a certain percentage away from the Ark County program. So the Ark County program is going to use the numbers in red. And those are going to jump because they're a 5-year Olympic average. We've dropped 2018 out of the formula. We bring in 2023. Corn price is going to jump to 503. Beans are going to 1217. Wheat's going to 672, etc. You go all the way down. You see the cotton price going up a little bit as well. So we're really finally getting the benefit of this, the way the Ark County program is structured. And the ARC prices are going to be the highest they've been since 2015 this year. So when you compare ARC to PLC, on several of these markets, ARC is very favorable. The other thing you have to look at is, does ARC make sense versus buying SCO? SCO is going to use the crop insurance price, and those currently are here in green. Might be off a day here, but when you look at corn, for example, I can get 86% with ARC for free, or I can get 86% SCO. I have to pay for it using 468. I would favor the county ARC program. Now, quick reminder, ARC and PLC protect 85% of your base acres, not what you plant, it's on base acres. So I think it's imperative that producers know what your bases look like, especially this year. Some years past, you know what, we didn't rely on these programs. We weren't going to get a payment anyway. Now with the market coming down, but the ARC prices going up especially, you need to know what your bases look like. And do my base acres reflect what I intend to plant this year? Is it going to match up? That way I know whether or not they truly provide some risk management for me. And so if they do, then to me, the county ARC program looks like a better deal for corn, beans, wheat, sorghum, barley. We'll look at some of the other markets here in a minute. Probably not for peanuts and rice, and probably not for cotton as well. But that's the decision you got to make right now. And so within the tool we have, the producer profitability matrix, we've included this worksheet this year to be able to kind of provide an apples versus oranges comparison. And so on the left-hand side, we've got an example of using SCO plus. I know that if I decide to buy SCO, I would be signing up for the PLC program. Compare that on the right-hand side to the Ark County program. Now, what I'm looking at is a side-by-side comparison. I used 1,000 planted acres For this example, I used 1,000 base acres. I'm pretty sure most of us don't have identical base and planted acres. There's usually a few acre difference. So again, that's why it's important to know. And by the way, this is a farm by farm, crop by crop decision. You may have 10 farms, 8 of them you got ample corn base, 2 of them you might not. And then you might decide to do something different on those 2 farms. But on the left-hand side, what I'm going to look at primarily is a price drop. I'm going to assume that we have an average corn yield for the year on both of these. I'm going to look at a price drop from the base price. I use 467 down to 420. The value of that crop with a 200 bushel APH is the higher of the 2 prices times your APH, $934. I'm going to assume that I buy a 75% RP policy just to kind of compare these two together because ARC is a 10% band. So this gives me an 11% band. That band is worth $102.74. On the right-hand side for the county ARC, we're starting at 503. I used a county yield of 190 on both sides and at 86% for the ARC well, first of all, the county benchmark is the top 2 multiplied, 956. That 10% band, the most you can get from county ARC is 10% of 956, so $95 an acre. 86% gives us our county trigger for the ARC program. On the left-hand side, you can see for SCO, if yield is unchanged, but we have a drop in the price, then we only had about a 10% drop in revenue. So with 86% insurance, 10% drop doesn't trigger any kind of a payment. However, if I sign up for the PLC program, I would be getting, if we end up at a 420 price, I'd be getting 6 cents a bushel times the payment yield at FSA times 85% of my base acres. And in that case, that would equate to about a $10,000 PLC payment, but I would subtract what I paid for SCO, end up netting out about $1,000. On the right-hand side, because of how high we started on price, and if we end up at a 420 average at the end of the year, I'd be getting a $24 ARC payment, which equates to about $20,000. So if you assume that we're going to have somewhat of a normal crop year and that price would come down, maybe in corn because we got big acres, the ARC program is going to be hard to beat. And same with soybeans, because we're starting out $1.50 higher for ARC than we are for insurance. I can't really justify buying SCO versus sign up for the county ARC program. But again, do you have base acres? That's the question. And if you don't, then if you want to protect that middle rung on your ladder, you might have to go to the SCO. Or you just don't protect that. You buy individual coverage and maybe you skip it and buy ECO up at the top end. For peanuts, showed this example down in Georgia the other day. It's really just hard to beat PLC with the ARC price, even though the ARC price looks like it's going to be higher on peanuts this year than what the base price is for crop insurance. The PLC price is still, SCO probably wouldn't pay because of how low we're going to be. But PLC is the way to go. And if prices stay where they're at this year, you'd get in this case, a $42,000 payment on 500 acres. On the right-hand side, you'd end up not getting anything. So I can't come up with an example to beat PLC on peanuts. For irrigated cotton, in cotton, you got 3 choices. You've got PLC, or you got the Stacks program, which means you can't sign up for either PLC or ARC. You got ARC County, and then you've got the PLC and potentially SCO. And so we're going to look at all 3 of those. On the left-hand side, if I decide to buy the Stacks coverage this year, if we're going to start out at 69 cents, let's say we go to 65, which is where we were projecting this year. Now they're projecting down to 63 and a half. So I probably should change this. But if I buy 20 points of Stacks coverage, and the price goes down 4 cents, it's not going to trigger any kind of a loss. So because of how low we're starting, last year we started at 83 cents. Stacks made a lot more sense. This year, it's just, even with the high subsidy level, you'd have to get prices down 61, 60 cents. If you decided to go ARC County and use that bump in the price to 40 and a half cents, you could end up getting a payment because of the price drop. If we take the market year average price down to where the government was projecting it last month for this year, you would end up getting an ARC County payment of $13 an acre next year. The third option then is the SCO plus PLC. And I still think PLC is hard to beat in cotton this year because if you do the math, walk down to the bottom, if the price ends up where it was this year, next year, then you're looking at a potentially a $22,000 PLC payment. And if you decided you want some extra coverage, you could buy SCO. Shoot, you could go up and buy ECO on cotton. And I didn't even show that because that's above this. So you could buy individual coverage, let's say 70%, sign it for PLC, skip 70 to 90 or and then or 90 or 86, go up and buy ECO from 86 to 90 or 95 to protect a shallow loss. A 5% drop in price, what's that, 3 cents, 3.5 cents? That could happen. And so, ECO or, hurricane or, whatever drought, 5% loss wouldn't take a whole lot. So that might be an option to look at on cotton this year. But I just have a hard time not doing PLC this year, considering where the market's at, considering the market conditions for cotton. So also want to remind everyone we have this producer profitability matrix. We can go out and plug in, what if I do this on insurance? What if these are my expenses? What if I forward sell some bushels? What if I plug in an anticipated ARC or PLC payment? And so I did that here with corn. Go back to the example we showed a few minutes ago with an 80% RP policy. Take out the cost, take out $900 an acre on 200 bushel APH ground, and 80% insurance does not cover my cost of production this year. 2 years ago, it would have. This year, that's not likely to be the case. So what else can I do if that's my goal, is to try to limit that? Well, number one, I check the box for SCO rather than plugging in a flat payment. I check the box for SCO. It's not going to be quite the same as Ark County. Ark County is actually going to be better than SCO, but Ark County uses different prices. Ark County uses a different yield, the county, and it's going to use the average for the entire year. And so I didn't want to add another layer to the matrix, but so I checked the box anyway to show some payment there. But the big thing here is ECO. And if I add ECO, add the premium over here on the right-hand side, it still may not be enough to cover $900 an acre this year, but it does get me in a lot better situation than what I was a minute ago. And the other side of it is, if it's lower into this graph where I'm struggling because of price drop, if I'm afraid we're going back to, 430 or 410 corn next fall, then why don't I start selling? And if I were to sell 100 bushel an acre at 475 cash for next year, you can see actually as the market goes down, my numbers get a little better. Worst case scenario is the price doesn't move. The sale didn't do me any good. I limited my loss, but I didn't generate a profit. So this is where we encourage everybody to know your cost of production. You can sit down with your agent, plug your numbers into this thing, use university numbers if you want on costs, whatever the case is. The one thing I'll point out here, though, this thing is a lot better looking than it was 2 months ago. Back in the middle of December, it was pretty bleak. When you had corn at 430, you had beans in the nines. A lot of these markets were looking pretty bleak. There wasn't a crop you could say we need more of this year. At the moment, I could justify probably planting more corn acres this year based on where prices are at. But the only true way to lock that in is to lock it in. And that's buying your inputs, making some sales. And if you're going to increase acres, I encourage guys to be selling those increased acres. Lock in that margin. If you're doing it because of margin, then lock it in. And so I don't think things are quite as bleak as what some of the universities have said, but that's because of the rally we've had. So I think over the next, from now till June, that's your best pricing window for most of these crops. I certainly want to take advantage of it. So this is what we've got to do over the next, 30 days, give or take. So time to visit with your agent, get a plan together, hopefully put your plan to work for you this year. How are you going to build your ladder this year? Some of us may leave a gap here. You can do that. You can buy your individual coverage, spend your premium dollars up here on that top end to get that 95 trigger. Maybe look at using ARC as providing that middle rung, that 10% band in the middle. I think that's going to be a popular decision this year. And in some areas of the country, I think that the decision making is going to be a little bit easier this year than it's been in the past. And part of that's been because of the rally we've had in the market. So here's what we got coming up next Monday. The markets are closed for President's Day. The 28th, we will have our sales closing deadline for our southern states. March 11th, we'll have our next WASDE report from USDA. Again, probably look at South America, but we're really looking at the U.S. demand numbers. Does USDA raise the corn demand? Do they lower bean demand? Any changes in the wheat or the cotton? We'll talk all about it on the 12th, plus any last minute things before sales closing on the 15th or the 17th in the north. Then we'll have a big report day on the 31st with planting intentions and grain stocks on the 31st. That planting intentions report is going to be big this year to see what we're projecting for acres. Those will be based off of actual surveys from producers. And then keep in mind your FSA deadline is April 15th. I would not encourage anybody to wait until April. I know you're all going to want to be busy come 1st of April. You're going to have to know what you're doing at FSA prior to crop insurance anyway. I would encourage you to get in and get that done. If you need your base acres, you can get a hold of the FSA office. They can tell you what your base acres look like. And I mentioned this earlier, but I think this year is as important a year as any to know your base by farm and how that compares to what you're going to plant. So with that, if we don't have any questions, I don't see anything in the chat. I certainly thank everybody for joining me here today. Hope you have a great month ahead of you. I know it's going to be busy in crop insurance, busy at the FSA office. So we're going to have a lot to do over the next 30 days. Hopefully weather permits everybody to travel. No questions. I'll shoot me any if you got later on, email, give me a call, whatever the case is. Appreciate the opportunity to visit with y'all this morning. Thank you and have a safe month ahead.